Investing in mutual funds is one of the best ways to grow wealth over time. But not all mutual funds are created equal. High relative profitability mutual funds focus on companies with strong earnings, efficient operations, and solid financial health. These funds have the potential to outperform the market while managing risk effectively. But how do they work, and how can you use them to maximize returns? Let's break it down step by step. 1. What are high relative profitability mutual funds? High relative profitability mutual funds invest in companies that generate higher profits relative to their size and assets. These funds prioritize businesses with strong earnings growth, efficient capital allocation, and high return on equity, ROE. The goal is to invest in firms that can sustain long-term profitability, even during market downturns. This strategy helps reduce exposure to companies with weak financials, which may struggle in volatile conditions. For example, a mutual fund focusing on high relative profitability might invest in Apple, Microsoft, and Visa, companies with strong cash flow, steady revenue growth, and industry dominance. 2. Why invest in these mutual funds? Investing in high relative profitability mutual funds offers several advantages. Higher returns. Companies with strong earnings tend to outperform the market over the long term. Lower risk. Financially strong companies are better equipped to handle economic downturns. Efficient capital allocation. These funds prioritize firms that reinvest profits wisely. Diversification. Mutual funds spread investments across multiple profitable companies, reducing individual stock risk. 3. Key factors to consider. Before investing in high relative profitability mutual funds, consider the following: expense ratio. Lower fees mean higher long-term returns. Look for funds with an expense ratio below 1%. Historical performance. Analyze the fund's track record over 5 to 10 years. Holdings and sectors. Check if the fund invests in industries with sustainable growth, such as technology, healthcare, and finance. Fund manager expertise. A strong management team is crucial for fund performance. 4. Top high relative profitability mutual funds. Some mutual funds consistently invest in high profitability companies. Vanguard Dividend Growth Fund, VDIGX, focuses on companies with strong earnings and dividend growth. Fidelity Contra Fund, FCNTX, invests in highly profitable growth stocks. T. Rowe Price Blue Chip Growth Fund, TRBCX, targets large-cap companies with sustainable profits. Dodge & Cox Stock Fund, DODGX, emphasizes value and profitability. Schwab Fundamental U.S. Large Company Index Fund, SFLNX, uses a fundamental approach to invest in high profitability firms. 5. How to invest in high relative profitability mutual funds. Choose a brokerage. Open an account with platforms like Vanguard, Fidelity, or Charles Schwab. Research the fund. Look at historical performance, fees, and portfolio holdings. Invest regularly. Use dollar-cost averaging to reduce market timing risks. Reinvest dividends. Compounding dividends can significantly boost long-term returns. 6. Mutual funds versus ETFs. If you're considering mutual funds, it's important to compare them with ETFs. Mutual funds, actively managed, may have higher fees but offer professional oversight. ETFs, lower expense ratios, trade like stocks, and provide flexibility. High relative profitability mutual funds are a powerful strategy for long-term investors looking to maximize returns while minimizing risk. By focusing on companies with strong earnings, these funds can provide steady growth and financial security. Are high profitability mutual funds part of your portfolio? Let us know in the comments.